Okay, let's unpack this. We're diving deep today into a really important topic: how to design those crucial retirement savings funds, specifically life cycle funds, for countries outside the typical developed markets we hear about so often.
That's right. And the context here is massive. Globally, we've seen this huge shift away from defined benefit or DB pension plans,
Right,
where an employer promised you a specific income in retirement,
right.
towards defined contribution or DC plans.
The 401k model,
Yeah.
essentially, where you become the chief investment officer of your own future.
Precisely. And this puts a significant burden on individuals to make investment decisions over decades. The challenge, most people aren't investment experts.
Definitely not. And that's where default options become incredibly important. Study after study shows that whatever you're automatically enrolled into, you're highly likely to stick with it. Inertia is a powerful force.
Absolutely. So designing smart, effective default options is critical. And life cycle funds, also known as target date funds, have emerged as the standard approach.
Right.
The core idea is quite elegant. They automatically adjust your investment mix, generally reducing risk as you get closer to your planned retirement date.
Right, the classic glide path. You're heavy in stocks when you're young, riding that potential growth, and then gradually shift into safer assets like bonds as you age. Seems intuitive.
It does. But here's the core problem the research we're looking at today tackles. The typical U.S. approach to life cycle funds, which often puts young people into 90% or even 100% equity exposure, might be entirely inappropriate, potentially too risky for emerging market countries.
Why would that be? Different demographics, different markets.
Exactly. EM countries have distinct labor market dynamics, different income patterns over a lifetime, and capital markets with their own unique risk and return characteristics. Simply copying a U.S. model and pasting it into an EM context isn't going to produce optimal results for individuals saving there.
So our mission for this deep dive is to understand how these funds should be designed for EM countries, specifically by incorporating two key factors this paper focuses on: what they term risky human capital and parameter uncertainty. And the paper grounds this analysis by looking at four specific countries: Mexico, Poland, South Africa, and Turkey.
Let's jump in.
Okay, let's start with the foundational concepts. The traditional life cycle theory, going back decades to pioneers like Boddy, Merton, and Samuelson, views human capital, essentially, your expected future labor income, as something like a safe, riskless asset.
Right. If you're young, you have decades of expected paychecks ahead. That future income stream is seen as a massive, stable asset supporting you. So to balance your total wealth, that huge block of human capital, plus your relatively small amount of financial savings, you should put your financial capital into risky stuff like stocks to get potential growth.
Okay.
As you age, your remaining human capital shrinks, so you compensate by de-risking your financial portfolio, moving into bonds.
It's a compelling idea.
Mm-hmm.
Use your future paychecks as the bond part of your portfolio when you're young. But this paper pushes back on that. It argues human capital is not riskless. Your labor income faces unpredictable changes throughout your working life.
Absolutely. You have temporary shocks like a short period of unemployment, a medical leave, or even taking time off for family. Your income dips, but typically bounces back.
Okay.
But you also face permanent shocks, things like a major disability that permanently reduces your earning capacity, or, on the positive side, a significant promotion that permanently boosts it.
So these shocks introduce genuine risk into that future income stream. It's not the guaranteed cash flow of a bond at all.
Precisely. And because human capital is actually a risky asset, the optimal way to balance your total wealth looks fundamentally different from that traditional model, assuming it's safe. That alone forces a rethink of life cycle fund design.
Okay, so risky human capital is one piece. The other core concept they examine is parameter uncertainty. We sometimes hear about things like mean reversion in markets, where volatility might smooth out over long periods. How is parameter uncertainty different?
Well, mean reversion is one market dynamic, but parameter uncertainty is about our knowledge, It means we don't actually know the exact expected returns, the exact variances, volatility, or the exact correlations between different assets in the future.
Right.
We only have estimates based on historical data, and there's inherent uncertainty around those estimates.
So it's not just the market that's uncertain, but our forecasts of the market's behavior are uncertain.
Exactly. And that uncertainty itself influences long-term investment decisions. The paper highlights this as particularly crucial in EM because historical market data might be shorter, less stable, or the markets themselves more volatile, making those future parameter estimates less certain than in developed markets.
Okay, so the paper takes these concepts, human capital risk and the uncertainty of market forecasts, and applies them to those 4 EM countries. Tell us about the study itself, the data they used.
They focused on Mexico, Poland, South Africa, and Turkey, selected because they have established mandatory or auto-enrollment pension systems with default fund options, making the research highly relevant.
Got it. And the data.
They used detailed age earnings data for each country. This is crucial because, looking at Exhibit 1 in the paper, the typical lifetime income profiles differ.
Oh yeah, how so?
Well, Mexico, Poland, and Turkey show more of a hump-shaped income rises, peaks in middle age, and then declines. South Africa is different, showing income that tends to increase more steadily throughout working life, peaking closer to retirement.
Fascinating how different income paths are across countries.
Right. They also pulled historical capital market data from 2004 to 2022 for stocks and bonds in these countries to estimate expected returns, standard deviations, and correlations. Exhibit 2 shows this. And again, you see big differences. Turkey had very high stock volatility. Mexico and South Africa were more moderate, and Poland showed high volatility despite relatively lower historical returns.
So they've got country-specific profiles for both labor income and market behavior.
Yeah.
How do they put it all together in their model?
So they modeled human capital not as a smooth line, but stochastically allowing for those temporary and permanent income shocks we discussed to happen unpredictably over time.
Right, the risky part.
Exactly. They also modeled parameter uncertainty using a Bayesian approach, which is essentially a sophisticated way to make the best possible estimates of market behavior when you know you don't have perfect information, constantly updating those estimates as if with new data.
Okay, makes sense.
Then they estimated the optimal investment strategy, how much to put in stocks versus bonds, aiming to maximize the total utility or financial well-being based on a person's total wealth, which includes both their financial savings and that risky human capital, rebalancing the portfolio each year.
All right, let's get to the results. What did they find about the optimal portfolio allocations? Starting first with just incorporating that stochastic human capital risk.
First, looking at the human capital profiles they modeled, Exhibits 3 to 6. While the median human capital changes with age based on those income profiles we mentioned, here's a key insight. The relative volatility of human capital, how much it could potentially swing, increases significantly with age in all countries, particularly after age 45.
Why does it get more volatile as you get older, even if the amount of remaining human capital is smaller?
Because those permanent shocks, like disability, major illness, or even unexpected career shifts, they accumulate over a lifetime. The uncertainty around your remaining earning potential is higher. By age 60, the standard deviation of possible future income often exceeds the median expected value. It really highlights how that safe asset assumption breaks down later in your career.
Wow, that completely changes the picture of human capital as you age. It's not a diminishing safe asset, it's a diminishing increasingly risky asset.
Exactly. Now, how does this translate to investment strategy? Exhibit 7 shows the baseline optimal equity allocations. The general pattern does show equity allocation declining with age, the standard glide path shape.
Okay, so far so good.
But here's the first big shocker. The absolute levels of equity allocation recommended are significantly lower overall in these EM countries compared to typical U.S. target date funds, which often start young people at 90% or even 100% equity.
So even for a 25-year-old in one of these countries, the optimal strategy isn't necessarily maxing out on stocks.
Not always, according to this model. Mexico and South Africa do show more aggressive allocations at young ages, starting near 100% equity for 24-year-olds.
Okay.
This seems linked to their steeper labor income growth curves early on and relatively more favorable market conditions, higher historical returns with moderate volatility compared to the others.
And Poland and Turkey.
Much more conservative allocations across all age groups. This is tied to their flatter income profiles, slower early human capital accumulation, and less favorable market conditions, lower return shire volatility in Poland, and particularly high stock volatility in Turkey.
So the initial big takeaway is you absolutely cannot just clone a U.S. model. Local labor market dynamics and capital market characteristics fundamentally change the optimal starting point and glide path.
That's the core finding right there. Now, they also ran sensitivity analyses, changing different factors to see how much they impact the optimal allocation.
Let's hear about those. First, how sensitive is this strategy to the discount rate used to value human capital?
The discount rate has a relatively limited effect. That's Exhibit 8, especially for older investors.
Why is that?
Because for older people, their financial capital is a much larger portion of their total wealth than their remaining human capital. So changes in how you value that human capital matter less to the overall portfolio decision.
Okay, that makes sense. What about contribution rates, how much you're saving into the fund?
This affects the timing of the glide path, shown in Exhibit 9. Higher contribution rates mean you accumulate financial capital faster.
Right.
As your financial capital grows relative to your human capital, the model shifts you into safer assets earlier in your life cycle. Lower contribution rates mean you rely more on human capital for longer, pushing the de-risking later.
That makes perfect sense. Your saving speed changes the balance between your human and financial wealth. How about risk aversion?
Well, as you'd strongly suspect, risk aversion has a significant impact. That's Exhibit 10. The more risk-averse someone is, the lower their optimal equity allocation will be at every age.
No surprises there.
No. The paper notes that for very low risk aversion, you might still see 100% equity for young people in some countries, like in some U.S. studies, but for more typical levels of risk aversion, the allocations are much lower across the board.
And the riskiness of the human capital itself, those permanent income shocks.
Also a significant driver. Exhibit 11 shows this. Higher volatility stemming from those permanent labor income shocks pushes down optimal equity allocations.
Because it adds another layer of risk.
Exactly. Since these risks accumulate with age, higher permanent shock volatility leads the model to recommend lower equity exposure earlier in life.
Okay, the outline flagged this next one as really interesting. The correlation between your human capital, your job income, and stock returns.
Yes. This is where the findings get potentially counterintuitive. It's Exhibit 12. If your labor income is negatively correlated with stock returns, meaning your job is stable when the market is volatile or down, your human capital acts like a natural hedge.
Right, diversification.
Right. It provides a diversification benefit, and the model says you can optimally hold more equity in your financial portfolio.
Like being a public sector worker and investing in tech stocks, your income isn't directly tied to the stock market swings.
Exactly. Conversely, if your human capital is positively correlated with stock returns, your job prospects or income tend to rise and fall with the stock market. There's no diversification benefit from your human capital. In fact, it makes your total wealth, human plus financial, more concentrated in the same source of risk. This decreases the optimal equity allocation in your financial portfolio.
Okay, still tracking. If my job is tied to the market, I should hold less market risk in my investments. That feels logical.
Right, but here's the genuinely fascinating part the paper highlights. Beyond a certain positive correlation threshold, they mention around 30% or higher, the optimal strategy can dramatically flip. Instead of the standard glide path where equity decreases with age, the model might recommend allocating bonds to young investors and actually favoring stocks for older investors.
Like a reverse glide path, holding more stocks as you age. That is completely the opposite of standard investment advice.
It's a powerful departure, specifically because of that strong positive correlation. The paper uses the example of someone working in the construction sector heavily invested in construction company stocks.
Yeah.
If demand for construction, impacting your job income, and the stock prices of construction companies are highly correlated, holding those stocks when your human capital is high and tied to that sector makes your total wealth incredibly exposed to that single risk.
I see. Too many eggs in one basket, basically.
Exactly. As you age, that human capital declines, so the risk from that specific correlation lessens relative to your growing financial capital, potentially making stocks relatively more attractive for the remaining investment horizon.
That's a lot to think about. It makes the connection between your job and your investments incredibly direct and potentially leads to strategies I would never have imagined.
It certainly complicates the picture beyond just age and generic risk tolerance. Finally, let's look at the impact of parameter uncertainty not being perfectly sure of those market numbers.
Right, the uncertainty about the forecasts themselves. How does that layer of doubt affect the allocations?
Exhibit 13 shows that parameter uncertainty consistently lowers optimal equity allocations compared to models where you pretend you know the market parameters precisely.
So if you're less certain about the market's future behavior, the model recommends being more cautious. That feels intuitive.
It does, and this effect is more pronounced in countries with higher underlying stock market volatility, like Poland and Turkey, compared to Mexico and South Africa, which had more moderate historical volatility.
So the more volatile the market, the bigger the impact of not knowing exactly how it'll behave.
Precisely. The less certain you are about a highly volatile market, the more that uncertainty pushes you towards safer assets.
All right, so wrapping this all up, what's the big picture conclusion from this research?
The main takeaway is crystal clear. Designing effective life cycle funds in EM countries absolutely must be tailored to their distinct demographic realities and financial market characteristics. U.S. models are not a universally optimal blueprint.
And the key factors driving this tailoring seem to be unique labor income growth patterns, local capital market assumptions, particularly volatility, and crucially, that potential correlation between human capital and stocks, as well as individual factors like risk aversion, the volatility of labor income, and the impact of not knowing future market parameters perfectly.
Exactly. And based on these findings, the author provides some pointed recommendations. First, fund managers and policymakers need to design these funds based on country-specific and ideally even sector-specific labor income patterns, including their volatility and their correlation with local stock markets.
Wow.
They specifically reiterate that positive correlation finding in the construction example as needing careful attention, possibly using more granular micro-level data.
So it's not just an EM fund, but maybe we need to think about a Mexican manufacturing worker fund or a South African service sector fund to capture these specific risks.
That level of detail, if feasible, could lead to truly optimized outcomes. Second, they recommend explicitly addressing parameter uncertainty in EM fund design, perhaps through scenario-based modeling or those Bayesian techniques, because of the higher market volatility and data uncertainty.
Okay. And finally, what about policy or broader market context?
Policymakers need to create regulatory environments that support the development and offering of these locally optimized, transparent, and affordable funds. The paper also notes challenges like some EM countries still defaulting people into overly conservative options.
Right, which might not be optimal either.
Exactly, and a lack of financial literacy preventing participants from understanding or trusting equity investments, even when they might be optimal for young savers. So improving financial literacy is also a crucial piece of the puzzle to make these tailored strategies effective in practice.
This has been a fascinating deep dive. We started by understanding the critical role of well-designed default funds in the shift to DC pensions, identified why standard U.S. lifecycle models might fail in EM, and then systematically broke down how factors like risky human capital, parameter uncertainty, local income patterns, and market correlations demand a completely different approach.
We saw that incorporating these risks leads to generally lower equity allocations than typical U.S. funds, but most surprisingly, how a significant positive correlation between your job income and the stock market could potentially justify a dramatic reversal of the traditional glide path.
Right, the idea that in specific circumstances, it might be optimal to hold bonds when you're young and stocks when you're old because your early career risk is so tied to equity market movements. That's a powerful mind-bending concept.
It really makes you step back and reconsider standard assumptions.
And that brings us to a final provocative thought for you, our listener. Considering how sensitive optimal investment strategies are shown to be to factors like the specific correlation between your job income and the stock market you're investing in, how might that change how you think about investing your own retirement savings, regardless of where you live?
It pushes you to look beyond generic advice and really consider the specifics of your own personal economic situation and how it interacts with the financial markets.